Hi, welcome to the Screencast podcast, where what I'm going to be looking at with is incomplete records, and in particular part where we'll use a statement of affairs and control accounts. Okay, quick bit of theory. Many small businesses don't use full ledger accounts of the double entry system, and that's very often when they first started because they haven't got the time, possibly haven't got the expertise. If you're a builder, you've probably never done any accounts training, and therefore it's also a cost element because you're not working at what you're good at, and therefore it's costing you not going out and building houses. And also, if you can't do it, you'll have to pay somebody. There are some advantages to doing double entry, quite a common exam question. Final accounts are a lot quicker and cheaper to produce if you do full double entry. Transactions can be checked and audited, and that helps to reduce the chances of somebody stealing money from you. Really important on this, and very often the reason why businesses move over to it, as you can run off an up-to-date record of what you owe to your trade payables to make sure you pay them, and what's owed to you by your trade receivables to make sure you can collect the money. You can run off financial information throughout the year, and that helps you to make decisions because you know how well your business is doing, not just at the end of the year, but also throughout the year. It's going to reduce the risk of errors because we've got all the control procedures like control accounts, and similarly reduce the risk of fraud and theft because we've got all the controls procedures that most of you guys know already. Okay, statement of affairs, what is it? Well, it's just basically a summary of all the assets and liabilities, and it allows us to work out capital at the end of the year. So, how do we do it? Well, normally we'll be providing an exam with a list of assets and liabilities and maybe some additional information. And what you'll need to do is to list all the assets at the top, the liabilities at the bottom, and then work out the capital at the end of the year. So here we've got two sets of non-current assets, motor vehicles, which we've got some depreciation on, valued at 25,000, some loose tools worth 10,000. Therefore, the total value of our non-current assets is 35,000. This business has got 4 current assets: inventory, trade receivables, bank and cash. So the total of their current assets is going to be 12,000, and therefore the total value of the assets of this business are 47,000. It's got some liabilities. If you look over here, it's got a non-current liability, which is a loan that was for 30,000, and the only other liability are some trade payables. So the trade payables and the loan added together come to 37,000. And now we're just going to use a standard accounting equation to find our capital at the end of the year. We know we have assets take liabilities equals capital. So going back to one of the first 1 or 2 lessons you did, and therefore the capital of this business at the end of the year was worth 10,000. And the additional information over here, because now what I can do, I can use this information along with the capital at the start of the year to find out my profit. And the way I can do it, I'll do it in a T account, but you can also do it just by working out the calculations as you would do in a normal statement of financial position. But I know my opening capital on the credit side was 8,000. And I also know in this case, the business has introduced $3,000 worth of capital into her business. So that goes on the credit side because that increases what the business now owes to Carol Smith. Got 2 lots of drawings. One's cash, as per normal, just following dead click, goes on the debit side. And she also took out some goods for $5,000. So that goes on the debit side. And what I know now for this business, I know that the balance carried forward at the end of the month, at the end of the year, was 10,000. So I haven't put the date on there, which I should have done, 31st of the 12th, 2016. Okay, press return. Just make it black so we can all see it. So what I now know is that my debit side is bigger than my credit side. There's only 11,000 in there. So I know that both sides of my account have got to balance off at 25,000. I've put in the balance brought forward, just because it's a good thing to do. And therefore I know that my profit for the year is going to be calculated by 25,000, take 8,000, take 3,000. So this business has a profit for the year of 14,000. Got a question here for you guys to have a go at, if it ever comes up. And then we'll have a quick look as well. I've got another set of questions for you to do on the use of control accounts. So pause the video. Okay, use of control accounts and incomplete records. Very often they do not keep, these businesses aren't keeping a full record of their sales. So what they can provide you with, just off the top of the head, is how much money they were owed at the start of the year, down here. Okay, just made that black now, that's great, 6,000. Okay, and as with a normal control account, that goes on the debit side because this is a total amount of money owed and therefore an asset at the start of the year. And what I can also do is put my balance carry forward because I know that goes on the opposite side. So at the end of the year, this business knows they are owed 7,000. So put the two balancing figures in. Now, all the other information in here goes on the credit side because, and this one here in particular, the checks from customers and the cash from credit customers, very often students want to put them on the debit side because they think they are the sales. The sales happened when the goods were exchanged, not now when the money is actually paid. That's recovering the debt. So we put both the cash and the bank from the credit customers on the credit side. We don't put in the cash sales because we don't put the cash sales through a control account. We'll use the cash sales information down here to work out the total sales. This particular business had one bad debt. That goes on the credit side because it reduces the asset of being owed money. We're never going to collect it. And they also allowed one large customer a discount. So we'll put the discount on the credit side because that reduces the amount of money that the customers owe to the business. And what we now know is that the credit side of this business adds up, or the credit side of the control account adds up to 99,700, and we know that the debit side should be 99,700. So we can work out the actual credit sales by subtracting 6,000 from 99,700, and hopefully that will come to 93,700. So it's like a normal control account. The only real difference is normally we're working out this balance carried forward, balance brought forward, and here we're working out the credit sales on the debit side. And you've really got to remember not to put the cash and the bank received in on the debit side. That's a really big error in exams. I now just need to add my cash sales onto that 93,700, and that gives me a total sales for the year for this business of 108,700, and that's what we would use in the income statement. Got two examples for you guys to do here. One's for the total trade receivables, one's for the total trade payables. Hopefully you won't have a problem with that. If I teach you, share it back with me, and good luck with everything. Thanks a lot, guys, for listening. See you soon. Bye-bye.